Good morning, or good afternoon, or good evening, depending on where you are, or for that matter, when you're watching this. My name is Jay Shamba. I'm the director of the Institute for International Economic Policy, or IIEP, here at George Washington University. We at IIEP are very pleased to be hosting this event on looking for balanced growth in China, insights from the latest IMF staff report, as part of our series on China's economy and US-China economic relations. For those of you who don't know us, IEP is located at the Elliott School at GW and is a cross-school interdisciplinary research center. We aim to serve as a catalyst for high-quality multidisciplinary research on policy issues surrounding economic globalization. That's a mandate we interpret rather broadly, so it includes work on international trade, international finance, international development, poverty studies, climate change, economic policy more broadly. And we've also tended to have a very large focus on China's economy, relevant to today, as well as India's economy. We've been quite busy at IIP lately. Please look at our website for upcoming events, and for that matter, since we record these events, if you've missed prior events, especially in this series on China, please go back and you can find the videos to all of those for the last year and a half as well. I'd like to acknowledge the IEP Executive Circle for their support and welcome any members in attendance. And I'd also like to thank Wenji Chen and Chao Wei, who you'll hear from later, for all their work organizing the year-long China seminar this year. And now I'd like to turn to today's event. So I think it's now perhaps 7 years ago, IAP started partnering with the IMF on rolling out certain IMF publications. I believe, if I'm correct, I believe the first one was a Regional Economic Outlook on Africa. And since then, we've partnered with the IMF rolling out a number of studies, including frequently helping roll out the World Economic Outlook. And while the IMF obviously does its own rollout of any kind of publication it's doing, one of the goals is to increase the collaboration and the discussion across the IMF and academia and policymakers and kind of the think tank world by bringing in different discussants to talk about the different publications and to give the IMF team the ability to talk in a little more detail with a little more analytical rigor about the work that they've done, as opposed to sometimes the more policy-oriented top lines in a normal rollout. And so we're really happy to be doing that today on the IMF's Article 4 rollout for China. I don't actually think, I should have checked our records first, but I don't think we've actually done an Article 4 before, and it's appropriate we're doing so on the one with China, given that for over 10 years now, the relationship between the US and China, China's economic development, and China's economy more broadly have been a major focus of IAP's programming and research work. So I'm really pleased to be here with the team today. So today we'll hear from Wenji Chen, who is a senior economist on the IMF's China team and a lead author on this report. Wenji is actually a former colleague at GW and former IAP affiliate, and so we're thrilled to have Wenji back with us today. We also have with us Helge Berger, who is an assistant director in the IMF's Asia and Pacific department, and I'm told he'll handle any questions that Wenji wants to duck. And then, as I mentioned before, we'll hear from Chao Wei, who is in the economics department at George Washington University and an IAP affiliate, who will offer some further comments after Wenji's presentation. But then we expect to have a decent amount of time for question and answer. So as questions occur to you, you can put them in the Q&A function below on your screen, and I'll bring those questions back to the panel after the presentations. So I believe that's all the administrative matters. And so I'd like to turn things over to Wenji.
Thank you so much, Jay, for the nice introduction. And for me, being a former faculty member at GW, it's really nice to come back. It's a homecoming for me. And as you said, the timing was not quite coincidental. Starting 7 years ago when I joined the IMF, we started this collaboration between the IMF and the IIEP, rolling out various of the public key flagship events. And I'm very glad that we can do this for the Article 4 staff report on China as well. So let me share my slides here, and I hope you can all see. So today I'll be giving an overview of the summary of the 2021 China Article 4 consultation, which we concluded end of last year. And as many of you know, one of the key pillars of the IMF is to conduct a health checkup on the economic well-being of each of our 190 member countries, one of which is China. And in that consultation, we talked to many of the various stakeholders, the authorities, but also NGOs, academics, about various key parts of the economy and how it is doing, and in terms of fostering economic stability, preventing financial crises, and raising living standards. And as you can imagine, there are many, many topics that one could cover. And so for this past year's, the 2021 consultations, our focus was really on, through the lens of the conjuncturally, the slowing growth momentum that we see, and some of the drivers that come with it, including the COVID pandemic, macro policies, financial tightening, and real estate, but then also focusing on long-term issues such as decline in productivity growth that we're seeing, the lack of economic rebalancing, the welcome but ambitious climate goals that they have recently announced. And one of the key assessments that we have is that through economic rebalancing, they can actually address many of these issues throughout our policy consultation. So in this case, I will be presenting then these key conjunctural parts that I just mentioned, and then follow up with the key policy recommendations. So let me dive right in. China has done very well in terms of its growth recovery. Coming out of the pandemic in 2021, it has clocked in growth at 8.1%. And that looks very impressive. Yet underlying that, what we see is a slowing growth momentum in the second part of 2021. And what I mean by that is that there are various components of growth that look to be weaker. And you can see here on the right-hand side, what we've done is to look at the growth trend of what could have been before the pandemic hit. So we compare the outturn of growth to what we thought the growth trend would have been without the pandemic, based on our forecast in January 2020 from the World Economic Outlook. And you see, while overall growth, GDP growth by the green line that's depicted came back to the pre-crisis trend, private consumption is still very much lagging behind. So it's not back to the level what we could have seen had the pandemic not happened. And underlying that are various reasons. One and foremost is COVID. The pandemic has put in various constricting measures on services, person-to-person services in particular, with the repeated lockdowns and outbreaks. There is also limitations to mobility. And you can see here on the left-hand side, when you look at quarter-on-quarter annualized growth, you see the zigzag, the stop and go pattern. And if you overlay the outbreaks, it would mimic that quite well. But there are other issues here at play besides the virus outbreak and the lagging consumption that's slowing down growth. And much of it is actually man-made or policy-induced. So here, let's take a look at macro policies, and we can start foremost with fiscal policy on the left-hand side. And what you see here is the cyclically adjusted primary balance. So it's the government's balance stripping off of any automatic stabilizer. So things that are cyclical in terms of, for instance, unemployment insurance going up during bad times, or less revenues from taxes as the economy is doing worse. So you can see in 2020, the government stepped up and really gave stimulus during the pandemic crisis. But then in 2021, this negative balance, which is meaning easing, has turned almost make a U-turn and has turned into positive territory, which signals a contractionary move of about 2.7% of potential GDP. So that's a big switch from a very supportive stance to a contractionary stance just on the fiscal policy alone, which has slowed down growth overall. And then on the right-hand side, in similar vein, although not in terms of the magnitude, you see also monetary policy changing from an easing stance in the 20s. You see here it's negative and then turning to more restrictive or contractionary towards the end of 2021, and then most of 2021 being more contractionary. And here, what's interesting on the Chinese monetary policy, just to note, is that you have these blue and yellow highlighted bars, and the Chinese use various measures for monetary policies, not just the policy rate that we're used to from other countries, but also what we call structural credit measures. So where it actually asks banks to increase and expand their lending to specific sectors in many cases, such as small, medium enterprises. But this does not stop here. In terms of the policy-induced tightening, there was also the real estate tightening. So being very concerned with high leverage among real estate developers, the authorities in the second half of last year instituted policies to really restrict the financing of real estate developers. It's called the 3 red lines policy, and you had to fulfill many different categories as a real estate developers in order to access funding. And as you can see, towards the second half of the year, a lot of those funding avenues that were available before became dried up to the real estate developers. And you have probably heard in the news on Evergrande and some of these big real estate companies really struggling during those times and continue to do so. Apart from the real estate tightening, we also had other regulatory tightening that came very sudden and very surprising to the market as well. So here on the right-hand side, you see the change in equity total returns. So market investors reacting to tightening in certain sectors, and they ranged from everywhere from consumer staples, real estate, as we saw from the left-hand side chart, but also in education, for instance, online tutoring. And a lot of the tech companies in particular were affected by that. And some of those regulations came with good intentions. So they were to enhance competition, to protect consumer data, consumer privacy. However, in the manner how they were, these policies were announced, there was a lot of surprise and unpredictability, which raised policy uncertainty and led to much of the negative market reactions. And let me say here, which I didn't put in as a chart, but along with some of these headwinds were also some of the announcements for climate targets. And while those were very welcome in terms of the carbon neutrality goals in 2060, the end of last year, we saw also a lot of governments at the local level trying to, in fact, adhere to the energy intensity targets, energy consumption targets, which have contributed to a power crunch among many of the provinces throughout the country. Now, what has led China to grow despite all these headwinds was, in fact, exports, and growth really was supported by very strong exports. And China's, I think, timing in terms of going into the pandemic as the first country and coming out of the pandemic also as the first country has really helped it to really have its manufacturing run and fulfill all the demand by the rest of the world in terms of pandemic-related goods, consumer goods. As you can see here on the left-hand side chart, exports are really going strong throughout even last year. Although in the future, we would expect as the pandemic comes to a winding down that some of these potential export demand from the rest of the world will unwind eventually as well, or at the very least shift from pandemic-related goods to other types of goods. And you can see some of that happening in the red bars on the left-hand side, creeping up more, although right now we still see very strong overall exports. And to be consistent with that, we have seen the renminbi also appreciate, in particular, the effective exchange rate through this high demand for Chinese goods. So that is consistent with that on the right-hand side chart. Now, pivoting from some of these short-term headwinds of why growth momentum has come down, let me address some of the issues that we have on the long term. And so remember, in this health checkup for the economy, the left-hand side chart is where probably a doctor would say, this is where you need to look out for. And what do I mean by that? Well, the left-hand side chart depicts domestic productivity growth. And as you can see from the early 2000s all throughout, we have pretty healthy productivity growth of about 3.5%. And this coincides with China's entry into the WTO, the opening up of its markets, privatization, but also a lot of SOE reforms. But then if you look on the red line here, the 0.7, which was the average productivity growth for the 2010s, that is really, really disconcerting and scary in a way. If this is really where the growth sources come from, domestic growth, then this is something that needs to be addressed for the longer term, but starting today. So from 3.5 to 0.7 within just one decade, and in terms of the external environment not being very favorable, as you can see on the right-hand side, with the technological decoupling coming up, and also the various geopolitical scuffling and China's more isolated stance going forward. The IMF team has done some research in that regard. If, for instance, some of the bigger technology hubs were actually technologically decoupled from each other in various scenarios here, with the fourth scenario on the right-hand side being the most intensive one, we would see actually a range of GDP loss of about 2 to 5% over a longer term period, but yet that is not helpful for the growth of the country in the long run and poses a very significant headwind going forward. And again, the climate agenda, which I mentioned before, it had the short-term impacts, which I mentioned in terms of the power crunch, but also going forward, it has to really come with a lot of costs in order to transition the country so much from very intensive, very energy intensive, carbon intensive type of growth to a more green type of growth going forward. To really reduce the CO2 and make it carbon neutral by 2060 will also involve a lot of cost, which can actually come against growth overall. And also, as you know, China has an aging population where the labor force is going to be much of a problem with, compared to many other countries who are already in that stage. So that is not helpful going forward for labor productivity as well. So having said all of these growth headwinds, that is the reason why we actually then make a downward revision to our growth forecast. And here I've plotted some of the vintages and to highlight some of the differences. So in January, the WIO publishes an update and gives all the various projections of the major economies. And you can see here, we really lowered the 2022 growth projections from the year before, from 2021, and the latest projections are at 4.8% growth for 2022 this year, and for next year it's 5.2, also reduced. Now, the risks, despite this downgrade in growth, still remain on the downside. And the main reasons for that are, you can see here on the left-hand side, the increased local outbreaks that China has and the zero COVID strategy along with it that is limiting mobility, but also at the same time having a negative impact on consumer confidence, raising uncertainty. And because of China's the lack of social protection system, there is this tendency to actually save more, so with higher precautionary savings. And that's why we see private consumption really lagging and not recovering as fast. And this is foreseeable here again, as the Omicron variant has also hit China, although with its very stringent COVID strategy, it has been mostly kept at the local level, and it has been usually controlled within a few days or weeks at the most. But at the same time, on the right-hand side, you see that the property developers are still facing very tight financing conditions. So this has not improved from what we saw late last year. And this has really also spilled over to some of the downward sectors. And we can see, for instance, an impact in terms of construction. End of last year might have improved a little bit, but this will have an impact on employment and then in turn on consumption as well as overall real estate investment, which plays a big part in terms of overall fixed asset investment, and therefore a downward pressure on growth. So what can be done to counter some of these negative impacts and the slowing growth momentum, but then also looking into the long term to counter these productivity growth declines and in terms of helping them with their climate ambitions? Let me start with the short-term policies, and in particular the macro policies. Now, on the fiscal side, as you saw from this really sharp U-turn from stimulus to contractionary, what our advice is to have fiscal support to move to a neutral territory. So even if you don't have the same stimulus, at least don't contract as much as last year. And in particular here, make the composition of the support shift from what the Chinese have usually done is to stimulate infrastructure. And our advice is to shift that stimulus towards household support, in particular for the vulnerable households who have a more likely chance to consume as they're more cash constrained, and therefore the marginal propensity to consume is higher, which will help consumption. But overall, this will also help strengthen, in terms of the fiscal policy in a longer term view, to strengthen social protection. And why is this important? As I mentioned before, because of this lack and inadequacy of some of the social protection system, such as very low unemployment insurance, pension system that's not available to everybody, especially the migrant workers or rural workers. By really supporting and strengthening the social protection system, you can actually lower this precautionary savings need at the individual level, at the household level, which then might stimulate some of the consumption, private consumption matter as well. And you can see here in the chart that China really has some of the highest savings as a ratio of GDP compared to many other countries. Now, apart from the fiscal policy, which should be front and center, monetary policy should be accommodative to support it. And here, CPI inflation is relatively low, and so there is still significant slack in the economy that we see. Now, one of our key advice in terms of monetary policy is actually to focus on policy rates, to lowering those, rather than using the other non-interest rate policy measures that I mentioned before in terms of the central bank telling other banks to give structural credit to certain sectors. While those might be helpful in crisis situations, in the longer term, they might actually be rather distorting in some ways if they're, for instance, having credit to some of the not so productive sectors where it should have gone to sectors that could have done more and more productive ways with the money. Apart from that, in terms of the policy advice in our consultation, one big focus was climate policy advice. And here we really tried to integrate the climate policies into the overall policies that we had, macroeconomic policies on China. And as the IMF has shifted to have more climate policy focus in its consultations, sometimes it can come across as more the standalone. So I think for overall effectiveness, what we thought would be really helpful is to integrate it into the overall macro policies. And here in particular, what stands out is the advice of economic rebalancing in the context of climate policies. And as I mentioned before, China has a very investment-intensive growth model that relies on high energy-intensive productions. which in turn relies on very coal-intensive power sectors to generate the energy. So in one of our exercises and analytical works with other departments within the IMF, we did this modeling experiment with simulations, as you can see on the right-hand side in the bottom chart. If we had, for instance, a scenario where China switches its investment share of GDP by 15 and lowers it by 15 percentage points towards more consumption intensive share. And we can see here just through this rebalancing alone and nothing else, and holding the GDP path the same compared to non-rebalancing, so continuation of status quo, we can see that actually this rebalancing alone can account for a 15% decrease in CO2 emissions alone. So that is very significant. But there are other policy advice that we give in terms of the climate goals that China can achieve. And one of that is using carbon pricing tools in terms of its existing emissions trading system, which just came online last year. But within that context, we also saw ways to make it more effective, for instance, by having market and structural reforms within the power sector in order to have the price pass through from the carbon pricing onto final consumers, and having a better signal towards investors of how costly and future costs of coal in fact will increase, and therefore then to incentivize more investments into the green type of investment and renewables. And lastly, the advice also involves green finance, which is really up and coming, and that could be a great way to leverage the financing that is needed for this huge endeavor from the private sector in particular. So other advice, again, to counter some of the downside risks is related to the property developer stress. And as I pointed out before, that is still ongoing. And here, I think first and foremost is really to make sure that these spillovers are contained. And there, if there were any bigger spillovers, that the authority should stand ready to really deploy all the fiscal and monetary policy support that they can, given that they have the fiscal space in order to do that. But along the same way, for the current juncture is really to improve the monitoring policy coordination, and then for the longer term, adopting structural measures to reduce the longer term risks that the property sector actually has come with the high leverage that it has accumulated over time. And in general, I think these policies should be accompanied with ongoing efforts to also address other high corporate leverage in general, and phase out all these implicit guarantees that have been given, and strengthening market-based insolvency and resolution frameworks, which we are also working on separately, as well as a working paper that will be coming out soon. Now, how to address the longer term issues, and this picture I showed you on the productivity declines, that is really eye-opening, and that is a key in order to revive growth again going forward for China, what to do there. And so we are continuing our work in that regard from last year's Article 4 consultation, and in this year's we also did some micro-related work looking into firms in terms of market dynamism in particular, how younger firms actually have a harder time as time has gone along in more recent years to compete with incumbent firms, and in particular with incumbent SOEs. And so to energize market dynamism, there should be more level playing field between SOEs and private firms. There should be opening up of many different sectors, in particular the services sector, where there's a lot of catch up that these firms could do to the frontier productivity levels that could be achieved. Now, on the regulatory measures that I mentioned before, that came very sudden and surprising to many of the market participants, in order to really reduce the policy uncertainty. And we know policy uncertainty is very bad for investment, for investors in general. Some of these intentions are indeed very good. So we do support those, but if these regulatory measures could be made more transparent in a more predictable and pre-announced manner, that would really prepare some of the market participants more in terms of their investments going forward. And lastly, the traditional type of public investments that have been used as fiscal policy to stimulate the economy, I think, are not a good answer going forward, as we saw a lot of overinvestment over time. But instead, again, before in terms of the composition, there could be more support to households. But if there needs to be public investment, those could be directed in terms of green investment, and some of which we saw recently. China, in fact, announced in terms of the building up of its grid system, transmission lines connecting renewables from faraway provinces to the key provinces in the coastal area. Now, in terms of the key reforms, as I said before, just to highlight some of the work that we've done looking into some of the key differences. On the left-hand side top panel, you can see here the capital productivity in manufacturing is really still very much wide gap between the private firms and the SOEs, despite some of the SOE reforms that we have seen. But I think there can be done a lot more work in terms of opening up, as I said, as well as some of the leveling of the playing field. For instance, some SOEs get more preferential access to loans that private firms don't have. So really, by helping these private firms thrive, especially the younger firms who are responsible for some of the higher productivity growth, I think China can do a lot to ensure that this 0.7 line does not stay there, but actually increase. To support my claim before on the general, on the government's stock of capital and the high level of infrastructure projects, you can see here that China's general government capital stock is very high compared to many other countries. And then on the bottom right-hand side chart, you see that the real total return, in fact, has been decreasing. So really to counter that is, don't invest in the same bridges into the roads that you have before, but really concentrate on things where you can get bigger returns, such as the green investment. And then the last chart on the left-hand side and the bottom is the increased policy uncertainty that we have really seen skyrocket in the last 2 years, that you see here on the towards the right of that panel. And in order to counter that, to have more predictable and measured and pre-announced and transparent type of regulation and policies. So with that, thank you very much. Let me stop here, and I look forward to Chao's discussion.
Great. Thanks a lot, Wenji. I want to turn things over now to GW Professor Chao Wei for some comments.
Okay. So let me share the screen. So thank you for the opportunity to discuss the IMF staff report. I'm Chao Wei, IEP affiliate and a faculty with the Econ department. So this is a very comprehensive report. It documents substantial amount of data, contains detailed analysis and insightful review from both the IMF and the Chinese authorities. So in this discussion, I'm going to focus on and expand on 3 important issues. The first issue is about the importance of understanding government behavior. So Wenji have talked about regulatory headwinds. So for example, in August 2020, the government imposed 3 red lines and aggressively deleveraged the property sector, which led to Evergrande bust last year. And also in July 2021, the government also implemented the regulatory reform, actually effectively dismantled the online tutoring services. And it's an industry which employed at least 10 million people, even just looking at the tutoring services to K-12 grade. And one of the biggest company, New Oriental, witnessed its stock market value went down by 90% and had to lay off 60,000 individuals. So such drastic campaign-like regulatory reform, especially in the depths of pandemic, so raise important questions from the government behavior perspective. So I agree with the IMF report on the importance of regulatory shocks, but I would advocate more research. Sorry, feel so quite easy. Advocate research from the perspective of government behavior. For example, we want to understand how did the government choose which reform to implement and how did they choose the timing? Are there any private information which are only known to the decision makers and they must implement the reform at that particular timing despite the pandemic? Are those policy decisions optimal? Are there missteps in timing and execution? And Wenji also mentioned the contractionary move in fiscal policy. In that regard, we also want to understand whether the contractional moves are intentional or it's actually unintended consequences because of bureaucratic delays. As the Chinese government often use public investment to stimulate the economy when they could not locate enough suitable public investment projects, they end up with surplus. They couldn't spend all the budget assigned to them. So understanding China government behavior and possible mistakes and the implementation delays are very important to understand their impact on the economy. So the second issue, and the report also mentioned is subdued consumption recovery. As we have witnessed, there's an uneven impact from COVID. Among the industries that are impacted most, for example, construction industries and catering and accommodation industries, those industries employ lots of migrant workers and workers in informal sectors. So those are people at the lower end of the income distribution. And it's also a worst year. 2021 was the worst year for small entrepreneurs. And they account for an outsized percentage of employment. And if we look at the new firm registration, in 2021, we saw 1.32 million newly registered firms, but 4.37 million deregistered firms. So the ratio of newly registered firms over deregistered firms is less than 1. Which actually was quite shocking. If you look at the same number in 2018, the same number, the same ratio was 25, means that there are 25 times more new registered firms compared to deregistered firms in 2018. And the ratio was 6 in 2019. So in 2021 is less than 1. So those bad news for the small entrepreneurs especially affect the lower end of the income distribution. So I agree with the report about the importance of economic recovery by dealing with a subdued consumption problem. And I feel it's important to look at the industry data, but I also would like to advocate collection of more data which focused on the distributional effect. For example, what happened to the income distribution, especially the lower end, and how much % of social insurance replacement are given for those impacted, and what happened to the saving rates across the spectrum of earners, and how was the issue with the banned mortgage debts, especially in some cities which, like Zhengzhou, which was both impacted by COVID and impacted by a huge flood. Okay, so we want to understand the income distribution. We also want to understand the marginal propensity to consume of different income groups. I feel with those more detailed data, we would understand more what policies need to be implemented for consumption recovery instead of always relying on the public investment for stimulus. The third issue I would like to talk about is the elephant in the room, the flagging birth rates. So we can see that from year 24, the birth rates have been declining, but the decline was especially drastic after 2014. So we can see that for per 1,000 individuals, the birth rates go from around 12 to 7, I guess, recently. And that was a projected 35 million drop in number of workers. It's almost like a 4% of labor force in the next 5 years. So as Wenji has mentioned, this is a huge problem for balanced growth. The first is population growth matters. Unless, is the population decline, unless it's compensated by increases in productivity per capita, it would need to decline in the output. And also the declining birth rates also create social security issues facing an aging society. But what I want to stress upon is what information actually is contained in the declines in fertility incentives, because young people are forward-looking when making decisions on whether to get married and whether to have children. So the declines in fertility incentives may reflect larger and deeper issues in the future. For example, the housing affordability, which related to China's development formula before, which heavily relied on real estate industries. In order for the real estate industries to support the economy, housing prices had to be at a certain high level. And the housing affordability now turn back to bite the fertility incentives. And there have been lots of complaints about the non-work hours and high work intensity, which suggest that whether the high speed of growth comes at the cost of lower welfare for young people. And there have been difficulty for college graduates to find jobs, and especially there's a strong preferences for jobs within the government bureaucracy and within the state-owned enterprise system. So relate to the hardship faced with small entrepreneurs. So one would say there's a concentration power in the state entities again, which is kind of different from the direction China economy took in the 1980s. So we are concerned about the vitality of the economy, and we are also concerned about, the outlook young Chinese people have for the future. And those studying, their perception of the future and really understand what information we can gather from declines in fertility incentives would be important for understanding China's future. So in all, I really enjoy reading the report. It's a comprehensive and detailed report, and it's a very interesting read. Thank you.
Great. Thanks so much, Chao. Those were some great questions there. So I actually want to start off maybe by turning it back over to Wenji, or for that matter, to your team on see if you have any responses to anything Chao raised before I bring some more specific questions. And I do want to remind the audience that they can use the Q&A function if they have any questions they'd like me to bring to the panel. So Wenji, I turn it back over to you.
Thank you very much, Jay. Thank you so much, Chao. This was a very interesting and very insightful discussion on your part. And let me also say a lot of my team members, especially Helga, my mission chief, is also online. And as he already said, he will take the tough questions. Let me start by answering a few or address a few of your remarks. No, we absolutely agree with you, in fact, on the distribution, that it's really the vulnerable households that are impacted. And I think some of that you alluded to. And there we actually have also selected issues papers that came with the Article 4 report, which I did not go into detail today, but some of my colleagues, in fact, looked at some of these issues by various income levels, and then the savings of those, the impacts of those, so and some of the marginal propensity to consume, the ratios that we could find there, and infer from that in fact the vulnerable households would be more likely, since they're actually disproportionately disadvantaged in terms of the social protection. And so they are the ones that need the precautionary savings, but at the same time also need to consume more, since they don't, in crisis times, have any social safety net to fall back on. And talking about the social safety net and social protection system, there is also an entire chapter in the selected issues paper that my colleague John Vollier did on the Chinese system, and on various ways. Really, he went into detail line by line in terms of how pension systems could be addressed, unemployment insurance could be improved, and some of that addresses some of the fertility declines as well. I think it's impacting overall. If you don't know if you can fall back onto a social protection system, you're less likely to have more children as well. So I think those things are connected there as well, in terms of pension, for instance, with aging. Again, there are different ways that John put down in terms of improving those. And one of them is the retirement age, for instance, to make it a little bit more sustainable, but also in terms of various contributions that could be raised in terms of the participants, and then making it also accessible to a lot of the rural and migrant workers that are not part of it, or that are very disproportionately shut out of that. And on the fiscal contraction and the public investment, I think there we agree with you in terms of the points that we made, is really, again, shift the composition. So not so much focus on the traditional type of investments, which are generally brown, but shift the composition towards household support. And if you do have to do public investment, focus on the green type of investment that will not only help with the stimulus, but also with the green and climate agenda. Now, let me give the floor to Helge to add on.
All right, here we go. Thanks, Wenji. Also, Zhao, nice discussion. So let me just emphasize two additional points. One, you rightly worried about the campaign style of the regulatory policies that started late in 2020 and sort of then really gathered steam in 2021, similar to the timing of fiscal policy that shifted rather dramatically from 2020 to 2021. Sort of this you know, the timing certainly was a little bit unfortunate, and not all of the regulatory policies that were sort of part of this campaign, you know, would fall into what we considered useful in the longer term. Competition policy in the internet, you know, tech sector, of course, is a global topic, right? All countries struggle with this. There's a long discussion in Europe. There's a long discussion in the US. And so, but these are long discussions and it takes time, and you should take the time to get it right. And so there's a concern with mixing some helpful policy areas with others that are more discretionary, and doing it all at the same time when the economy is just trying to get out of the pandemic slump, and together with the rather brutal fiscal turnaround that Wenji described, you know, this may have contributed a lot to the surprising slowdown last year. Campaign style policies rarely outside a crisis environment sort of, you know, are, especially in the regulatory sphere, a good idea. I liked that you were concerned about the small firms. So let me just emphasize something that also came out in Wenji's presentation. Small firms and their, you know, and the rate at which they enter markets, new markets, the rate at which they grow after entering a new market are, you know, if you wish, the bedrock of firm level productivity growth, which is, you know, where really productivity is coming from in any country. That's also true in China. And we have seen a decline in that type of market dynamism that started much before last year's growth slowdown. And so you can say that what happened the last 2 years has added to a trend that has been varying for many observers for a number of years. And if you ask what can be done about it, the work we've done for the Article 4, and that's another second issues paper that people can pick up if they want, it's all published and available, is that we noted that some of that decline in market dynamism is associated with, we don't really have causality identified in the approach here, it's very difficult, but we can say it's associated with a large presence of SOEs. So in a given region, at a given time, if you see market dynamism in terms of new entry of firms and fast growth of firms after entry decline, you also often see the role of SOEs increasing. Of course, that's just correlation, but it gets you to a larger topic that has to do with SOE reform, with reforms that ensure market neutrality between private and state-owned enterprises. And there we have, that's a long-standing topic for us. So I appreciate the fact that you were pointing that out.
Great, thanks. I want to maybe as a first question, kind of continue to push on some of the, and once you answered some of this, but maybe just drill down a little bit more on the drop in consumption, right? To the extent that that's a big part of this topic here, when you talk about rebalancing and you emphasize that both from a rebalancing to be less dependent on net exports, but also you tied the increase in consumption as a potentially key channel for the climate goals as well. It feels like a crucial one. And so if we think about that first chart you showed, or the chart on your first slide, which is a very striking one, that GDP is sitting right around what the IMF thought pre-COVID, which is in many ways just remarkable, right? There are other countries that have come back to level, but coming back to trend is really quite something. But then on the other hand, have consumption so far below, right? And so I guess then the question becomes, if you think of it just in buckets, it could be because household income is down, right? That GDP has come back, but household income hasn't. It could be because household income is back, but to kind of Chow's points that maybe distribution is different, and therefore more of the household income is sitting in lower marginal propensity to consume households. Or it could just be that marginal propensity to consume overall came down, right? Possibly because of the constraints on services, the ability to consume services, travel, et cetera, et cetera. So I'm curious where you think the key lever, or is it a combination, or how you think about that drop in consumption into those different buckets. And I should add, these are questions really for any of you, Wenji or Helge or Chow for that matter.
Wenji, are you dropping this in my lap? Otherwise, you feel free to start.
I can take an attempt to start off. By the way, there are many Wenji Chens on there. These are all my teammates. So if they can change their names and want to jump in, they're welcome to as well. So I think Jay brought up many good points, and consumption is really an area where we are very concerned about. And I think all of these things contribute to the lack of recovery of consumption back to trend. Like you said, in terms of COVID, I think that's a big deterrent, not just in terms of the mobility restrictions, the lack of travel, the lack of certain services that people just don't enjoy because they're excluded from it. It's not happening because of mobility restrictions. But also, I think the uncertainty surrounding that, right? Like instead of going to a place that you wanted to go, you'd rather not go, even if it's safe, because at any point in time, there could be a lockdown. And this continued zero COVID strategy is really limiting and consumption in that regard. The other part, as you mentioned, I think is also a drop in income. So I think that's from the other sectoral regulations that we have seen, particularly the real estate sector, which is a huge employer in terms of the construction, the services that come with it. And so we see this drop in income of some of those households that just lost their jobs because of this crackdown, and as well as in some of the other regulatory sectors. And then I think another big component that plays into this is the lack of social, not the lack or the inadequacy of social protection system, where now the margin propensity to consume might be just lower because you're in these very uncertain terms. Any day you could lose your job. You have restrictions. The SMEs, for instance, were not recovering, and I think those numbers that Chao shared were really eye-popping to me in terms of how many registered firms to deregistering, right? So those are the key employers as well in the economy. And so I think having that part as well is lowering your expectations in terms of future income sources, and therefore heightening your precautionary savings sense. And the combination with the lack of adequate social protection system makes you a lot more restrained in terms of consumption. Let me stop here.
Helge or Chao, anything you want to add?
You go first.
Oh, okay. So I just want to add a comment is that I think much really depends upon the economic structure of China, whether the country would like wealth to be with the people or be with the country. Okay, so if the fractional consumption of GDP in China is as large as in the United States, I would think that the government may not have so much leverage on the economy as it has now, because the Chinese government really rely on public investment for stimulus for reach the GDP plans they set forth. So this is how the economic structure is built. So really structural reform is needed if they want consumption to play a bigger role, and also in terms of economic structure should shift more to have wealth with the people rather than with the country. So that's what I want to add.
That's a good point. I would add yet another, which is that in terms of the way Chinese policymakers think about stabilization of the business cycle, is surprisingly neoclassical in its approach. Right? So the go-to approach, other than infrastructure investment, is to support firms. The thinking is that if you support firms, and that includes small firms if necessary, they will be able to employ more people, and it's the employment that then supports income of households. In principle, this is a valid approach, but I would say that most macroeconomists thinking about this and thinking about stabilizing the business cycle would say, well, there are many advantages of supporting low-income households directly through government transfers in the social protection system. And this is where this comes together with the more structural issues. So we have a weakness of consumption in the short term because we don't have the strength of the social protection system that ideally we would like to see. And that weakens consumption recovery, but also, of course, raises concerns about balancing the economy away from investment in the future. So there's a deep set belief, it seems, of policymakers that firm support is preferable to household support. And I think we would think that unless you have social protection at a level that is adequate for a country at this income level and this degree of development, that may be a little bit of an unbalanced approach to this problem.
Thanks. I want to then jump to Chao's point she raised as the elephant in the room, because I will say that when I was taking notes earlier, reading some of the things, and in particular, Wenji, during your presentation, I had written demography with a bunch of underlines under it and a question mark. And so I wanted to come to it in particular to this one, ask you about this one specific point Chao made, which was the idea that over the next 5 years, you may actually see a non-trivial decline in the working age population. And if you pair that with, Wenji, your slide on productivity growth, right? And also with the IMF's forecast of 5% output growth, right? Economies are complicated things, but on the other hand, in a measurement sense, output is simply output per hour times hours worked, right? And so if working age population is declining, you would either need productivity growth that is just fantastic, right? Way above where it was even in the better period you showed, let alone where it's been the last 5 years. Or you've got to find hours worked somewhere else, not through population growth, but labor force participation in some groups, or hours worked per worker or something. So I guess I'm just curious, given the demography, what can sustain output growth in the 5% range? I think maybe starting with Wenji.
Helga, are you okay? Can I? I'll give a stab at this. No, absolutely. I think the demography and the decline in the working age population will be a big headwind coming for China. So there, as you laid out the different ways of looking at growth, right? I think another way of thinking about this is also that maybe the 5% or the 5.5 or 6% that China has had in the past might be a thing in the past. So going forward, instead of looking at very high growth going forward, let's look at more sustainable growth, or growth that we called high quality growth, where it's very balanced. So there's big part from consumption, and inclusive, that's benefiting everybody, and that is also green. So again, this rebalancing really plays a big role here, to not just make growth high as possible with this public investment model that they did in the past, but really to make it such that it's sustainable in the long run, even though overall growth might be lower than what they envision in terms of the 5 or 6 or whatever percent that was in the past. And so, yes, productivity still has to play a big part in all of this. And a lot of those things that we said in terms of the market dynamism and improving the level playing field for many of the private firms will matter here. Opening up these sectors, having normal or similar access to financing across all different firms will be important as well. And so there's a lot of catching up to do. One of the reports, not this for the 2021, but the 2020, we had a very nice working paper accompanying that, looking at really what measures could be done in order to enhance the productivity of these private firms compared to some of the SOEs, and market reforms to the SOEs to make this more a level playing field for all firms. And there we showed, for instance, in sectoral view, which of the sectors in particular could benefit from more of these measures. And one thing that stood out to me was really the services sector. And there again, you can kill 2 birds with 1 stone, since services tend to be also less carbon intensive. This can help with the climate goals as well. And as we know, there's so much need in green and renewable energies, in the grid systems, storage, battery, CCS, carbon capture, etc. Those are all areas where there's a lot of productivity growth to be seen. And I think developing and investing in those will be very promising going forward as well. Let me stop here.
Okay, so if we follow the previous order, so I think the Chinese government have been trying in several ways to deal with the problem. One is to maybe changing the retirement age, and also the Chinese authorities also. I also read from the report in some replies, Chinese authorities mentioned that there are still rural labor force that can be released into market sector. And so that's the first, first aspect they deal with the issue. The second is that they try to encourage innovations. try to encourage increases in productivity. So for example, in one city, I think in Hangzhou, the city government actually promised to pay back part of the loans if the entrepreneur efforts by the college students fall apart. So they would pay part of the loan. So in some way, it's like a campaign style to try to stimulate innovation, but whether such approaches would work or not, it's hard to know. And the third thing, I think it's not how government deal with the issue. It's actually my concerns, which relate to my discussion, and there is actually a shift of labor force from market sector, from more productive sector to less productive sectors. For example, before we try very hard to pass the college entrance exams. Right now, the hardest exam is not a college entrance exam. It's the entrance exam to become a government employee. The admission ratio is very small, and compared to the people who are interested in becoming a government employee. So there's a shift of intention to work in more stable, in some ways less productive sectors compared to productive sectors. So in that way, that's actually going against increasing the productivity of the economy. So I think that that's a big concern in addition to reduction in the labor force.
Yeah. Zhao, if anything, you have made me more pessimistic now than I was before. I would only add that campaign style policy measures, industrial policy in general, but in particular as a campaign, don't have a particularly strong track record as government interventions in favor of productivity. Productivity is ultimately a microeconomic issue, and there we go back to the private firms that Wenji discussed and you just discussed. Just to bring one point home here, infrastructure investment is often missing in many countries, but in the Chinese case, that's really not at least not the most pressing issue. Production functions are concave, and the productivity that is associated with infrastructure, public infrastructure, is also decreasing. I think we are, that's where we are in the case of China. The one area that I would stress here is that education could be a challenge going forward that the government may well want to take up. As the workforce shrinks, you can do pension reform, you can extend working age, you can see whether there are more migrant workers who you can allow to migrate to where the jobs are and on the coast and so on. So all of this is helping. But of course, education, just like in advanced economies that are aging fast, is another area. But I think the main issue here is productivity, and then ultimately is a micro issue, and we have to see that private firms are encouraged to enter markets and then are allowed to grow fast. That's I think where the secret to growth is.
Thank you. We had a question in the chat that relates a lot to some of the conversation on consumption is the continuation of the zero COVID policy as really a binding constraint there. And so one of the questions in the chat was just pretty straightforward, which was, is that sustainable? Do you foresee any changes coming up? Obviously, there are some countries that pursued a different route, but there are other countries that did look a lot more like a zero COVID strategy for a long time, who have now more recently shifted away from it. And so I guess the question is, does either in the conversations with authorities or as part of the Article 4, is there any thought of the sustainability of a zero COVID strategy over time?
Yeah, let me classify this as a Helge question. So the great one, of course, and I think it's very prominent also on the mind of policymakers in China. So that's less a reflection of our discussions with them. Of course, it came up there as well, but just from seeing what recently is being discussed in Chinese media and by by people associated with the Chinese CDC, and so on. So it's very much in people's mind, and it's an important question. Let's just state by saying the obvious. I'll start by saying the obvious, which is that this is a balancing act. Right? So if you have a large population, let's say that is vaccinated, but where we have questions on the effectiveness of the existing vaccine with regard to the new variants, where you have to weigh the potential health risks of a sudden change in that strategy. I think that's an obvious point, and it's not on us, and I guess not on anybody telling the Chinese how to weigh these very important questions. But clearly, it weighs on growth. You guys talked about consumption, so that's obvious. The frequency of outbreaks has increased dramatically. Right? So we used to have long breaks. The zigzag quarterly growth number that Wenji had in her slides shows that. Now it's like, there are days or weeks only between outbreaks, and they can become quite substantive. So one way of dealing with this is to be more flexible in the way you deploy these lockdowns, and that seems to be happening. We indeed see traces of the marginal impact of yet another lockdown on economic activity to be decreasing slightly over time. But of course, there's a limit to how far you can go there. And otherwise, it's about making sure you have effective vaccines, and you see what you can have available in terms of these new treatments of the disease post-infection. And I think that's probably where the discussion will be going. But again, I can just warn about simple solutions that say, well, just open up and see what happens. I don't think the world wants to see what happens. That's really not a responsible policy advice.
Thanks. Another question in the Q&A that I wanted to raise, and I think this is probably most directly for you, Wenji, was just someone asked if you could say a little bit more about the analysis behind the cost of decoupling when you talked about what that was doing to productivity, and if you could just speak a little bit more to that point.
Sure, let me take this one. Our colleague who actually did the main work on that is not with us right now, he's on leave. But essentially, this is a working paper that was published last year, and one of the main authors is Diego Ciardero. And the idea behind this is this was done in terms of simulations using the big GIMP model that the IMF has, the Global Integrated Monetary and Fiscal Model. And various countries that are key hubs were positioned together. And so the 4 scenarios are essentially ways of which of these hubs would break off with one another or stay together in coalitions. And they looked into 3 main channels. One is the reduction in global trade flows, so whereby rival countries impose higher non-tariff barriers, so to kind of eliminate some of the relative demand of high-tech exports. So that's where one of the main channels would come from, not trading essentially with each other. And then the long-term impact on outputs, they also looked into sectoral misallocation. So some countries, because they couldn't get this from another country, what would they have to do in order to make up for that? And so the resource allocation impact from that. And then they looked also into the knowledge diffusion channel. So if you're stopping to import these high technology imports where you could learn actually from some of these or benefit from the spillover impacts, if you don't have those anymore, then empirically, how would it impact your overall productivity, your R&D spillovers, part of that, the patents that couldn't come with that, and how that will translate into overall growth. So based on these configurations and these 4 scenarios, I think the 4th one, the red bars that I showed you, was the most extensive, where everybody just really went into autarky. And so in terms of the impacts, they did it up to 2030 in terms of the impacts, and the cumulative changes were between 2% and 5% loss of GDP.
Thanks. Kind of as a connected point, I wanted to ask, when you talked about you had on one of your slides a picture that was showing, I think we name it now, Economic Policy Uncertainty Index, right? And you talked about that in part in connection to regulatory shifts that have taken place, and I think you've all spoken to how dramatic some of those in the real estate sector were in their impacts. I was wondering, though, especially looking at the timing of when that uncertainty index shifted, how much of it is actually reflecting regulatory uncertainty, and how much of it is about trade conflict with the United States and kind of decoupling type of issues, and then later on just about COVID, that COVID, whether it's just the disease or whether it's about lockdown policy or things like that, and just thinking about other countries in particular. If you look at an index like that for the United States, right, it looks a lot like the one for China, and it's not about a massive shift in regulatory policy as much as trade policy and then COVID. And so I'm just curious how much you see those different forces showing up there.
No, that's an excellent question. I have to say this economic uncertainty index was taken from Nick Bloom's website, so we did not actually construct it. But in all fairness, the authors there did a couple of things. So first, they made a measure based on Chinese newspapers using economic policy, and then they have a separate measure just for trade. So this one that I used is the one without the trade. So hopefully those will be abstracted, although there will be spillovers, as you can imagine. Now for the COVID ones, those policies, I think they will be embedded in there in terms of general economic policies that were in relation to COVID. They also did a separate index using the South China Morning Post, which is an English-based newspaper, and just for robustness to see how economic policy uncertainty translates into the English language-based audience, and there actually they found very similar type of distribution compared to the Chinese one. So to your question, trade is controlled for to the best of possibilities. COVID, maybe not so much.
Great, thanks. Yeah, okay.
You have other measures of uncertainty too, right? So you can look at the services providing industry, including the smaller firms, and their monthly PMI responses. And there you can see the COVID episodes hitting rather quickly, and you can also see how the impact over time shifts from being both a contemporaneous and a forward-looking one to one that is more contemporaneous as people understand that these things come but also go. And the equity markets react rather strongly to the tech regulations, and you can see any new item that the Bloom Index would also pick up, having sectorally differentiated impacts there. So it's not just the news.
Thanks. I wanted to make sure to have some time to talk more about the climate aspects of the report, because I know, as Wenji mentioned, this is newer for the IMF to be putting more in about that. And so I wanted to ask a couple things about that. So in particular, one struck me was the reference to shifting from investment to consumption as a potential substantial margin for achieving climate goals. And I think maybe one of the things that struck me is sitting in the United States, there's often a lot of conversation that what is needed to achieve US climate goals is actually to increase investment, right? That it's going to require investment in new types of energy, investments in new types of cleaner infrastructure for transportation and things like that. And so I guess that was one of the questions is the idea that there's just so much investment going on that you could shift the composition in a greener direction and reduce it? Or is there some tension between the need to do massive investment in cleaner energy on the one hand, but then also somehow reduce investment and increase consumption?
Yeah, let me take a stab at this. In terms of the investment needs, they're still very large by all means for China, even though the authorities have invested a lot in renewable energies. Just to give you an example, I think last year's investments into offshore wind energy in China was, and this year's, they were similar to the entire, I think, renewable energy of US combined. So, I mean, to that kind of scale, China is really at the forefront in terms of renewable energy investments, and it'll continue. They have very clear goals in their 5-year plans to increase the share of non-fossil fuel as part of the total energy consumption to, I think, 25% by 2030. And so that is on track, and that's very much a component that's necessary. But the rebalancing part, which we pointed out and which can play a crucial part in their realization of their climate ambition, is one where we think that it not just benefits the climate plans per se, but it will also benefit their overall economy, as we discussed in terms of the unsustainability of lots of the traditional public investment that they have been doing. And because of their investment intensive growth model, they have many of the sectors that are very high polluting. So for instance, the steel sector, the aluminum sector, cement, all of these things that go into real estate, go into road infrastructure projects, for instance, which was a traditional pillar of their growth. Those rely highly on coal-powered energy. And so shifting that growth model to more consumption-based, and that is generally linked to more services-based type of on the supply side, that is less energy intensive and therefore does not require the use of fossil fuels, and simultaneously then change their fossil fuel model, energy model into a renewable model with the help of the ETS. I think that's a striking combination together to get them to their climate goals while also helping their overall economy, is in particular this trade-off between growth, energy security, as well as their climate ambitions, which we saw end of last year resulting in some of the power crunches. And I think this rebalancing would just reduce some of that trade-off. It won't eliminate it. There will be still this friction going on, but imagine the economy does not need as much energy. Therefore, you don't have to provide it as much with these very dirty, polluting type of fossil fuel, coal in particular, power plants.
Great, thanks. So we're nearly out of time. And so I actually just want to, in some sense, give everyone a chance if there's any other comments that they were hoping to bring forward, or any concluding remarks that you had. So maybe, Chao, if there's anything last that you wanted to raise, or either questions or comments, and then we could finish with Wenji.
Oh, I'm fine.
Okay,
No questions.
Thanks. Wenji, any concluding remarks?
Thank you very much. I just thought this was a great discussion. Thank you very much, Chao, for your very nice discussion points. Lots of food for thought for our next consultation, which will be underway soon. And so, Jay, thank you again for hosting us, for the excellent questions, and I look forward to coming back. Thank you.
Well, great. Thanks so much, Wenji, to you and to the whole IMF team. As I mentioned at the start, this is always, I think these events have been terrific, and I'm really happy that we have this, this partnership going forward. So thanks for bringing this report to us. Really interesting things in it for anyone who hasn't had a chance to read it. I definitely commend it to you. And again, thanks to the whole team for the work there, Wenji and Helga for bringing it here, and Chao for a really insightful discussion. So thanks to all of you, and I hope everyone has a good rest of your day.